Coface is one of the leading trade credit insurance company, 70 years history where we've been acting on business-to-business trade. We like to say, and this is our tagline, that we are for trade, in the sense that we facilitate trade between businesses by providing credit risk management solutions. So trade credit insurance product is very much the core of our business and of our solutions, but we also have some ancillary services such as information services as well as debt collection. We are proud to say that we have amongst the players in this sector the largest international footprint. We are covering something like 540 billion euros of exposure on an ongoing basis. And for this, we are leveraging a quite unique database. It's the same single database that all our entities are using worldwide, where we are monitoring the information and credit worthiness of 80 million companies worldwide. Our risk underwriters are taking up to 10,000 credit limit decisions per day, and this again across a network of what we call risk information centers. We have 50 of those all across the world. We also have, and this is something that gives us a unique opportunity to observe what's happening at economic level. We are also paying claims that are obviously the result of payment delays and default. And just to give you an order of magnitude, on an ongoing basis, we pay up to 1,000 claims per week. Just a word on our presence in the Middle East. We have 50 professionals between Dubai and Cairo. Our exposure is in the range of 7 billion euros and is spread across 13,000 companies. I'd like to take a few minutes maybe to share some of the specifics of trade credit insurance, which is very different from other commercial lines of insurance. So the first aspect, I guess, is that credit insurance goes far beyond, let's say, the usual or typical risk transfer. It's very much about facilitating the supply chain finance by way of providing an alternative to some typical financing tools in business-to-business trading, such as letters of credit. So that's, I think, an important aspect to note. It also requires a very high level of expertise. Our products are quite complex. It usually takes up to 5 meetings to sell a policy to one of our clients, and the typical cycle time to convince newcomers to trade credit insurance is 3 to 6 months, to the extent that actually intermediaries and brokers. Would it be possible to put people on mute, please?
Hassan, you can unmute.
Thank you. So yeah, I was mentioning the expertise aspect of this line of business again, which is very well illustrated by the fact that all intermediaries, brokers specifically, that are acting in this line of business have actually dedicated teams that do nothing but trade credit insurance. The risk underwriting is quite different as well, in the sense that where most commercial lines of insurance usually focus on underwriting criteria that pertain to the policy holders or their assets, in trade credit insurance, the peril and the default risk actually lies more on the customers of our policy holders. So that's why the risk assessment, the risk underwriting is actually based on analyzing the portfolio of customers of our own policyholders, which makes it, again, I think, quite distinct. The dynamic nature of our exposure is something also which I think is quite different. Indeed, given the scale of exposure that we are managing and the dynamic nature of business-to-business trading, we have the ability contractually to cancel or reduce the credit limits that we provide to our customers. Obviously, when we make such decisions, everything that was covered until that point of time remains covered, but after such notifications, our covers do not apply anymore, even in the life of a same policy insurance contract. Recoveries is also something quite interesting in our line of business because we have a wide debt collection agencies network that we deploy when we have a claim that is declared to us. The terminology exactly is that we subrogate ourselves to our policyholders. And why I'm mentioning this? Because these have a material impact to our loss ratio and bottom line, essentially. Last but not least, the business development dynamics of B2B trading are basically made around new clients, new markets that our policyholders want to explore. They launch new products, they sign new contracts, and all of these at each and every time leads them to request for new or additional credit limits. And that's why if you add to that the typical turnover declarations that they have to make on a regular basis, from my humble experience in all lines of insurance, I don't know any other line of insurance where you have so much contact frequency with your customers. So I thought it was interesting to share with you some of these specifics of trade credit insurance. Now, let me start by sharing with you some outlook on the pandemic spread. It's quite unusual to start an economic update by sharing some data about death tolls, but this is a sanitary crisis, so it's very important to analyze and understand the evolution of the sanitary crisis in order to understand the economic scenarios that are ahead of us and that we are forecasting as Coface. So overall, it seems that the peak is behind us. It obviously varies between countries. Some countries have stepped into this outbreak sooner than others. But when we look at the death toll at the global level, and this is data, I think, up to last Saturday, the peak of the first wave, I'll come to that later on, seems very much behind us, which is good news. When it comes to emerging economies, most analysts and specialists have been positively surprised by the fact that emerging economies have managed this crisis quite well so far. Some would say it's due to the fact that they have younger populations, that some of them have had the opportunity to manage these type of pandemics in the past. Now, having said that, if you look at those countries here for the Middle East that are in green, they are also at different paces and at different stages of evolution of the pandemic. I think a notable difference, for example, is between the UAE and Saudi Arabia. Now, there's also something interesting to observe, which tends to indicate that this virus has actually some seasonality nature, is what we are observing on the southern hemisphere. So many of the Latin American countries now are seeing a steep increase of daily cases and death toll, and South Africa is in the same situation. Now, the one thing I would like to call out for the following slides and forecasts that I'm going to share with you is that our base scenario at Coface is that there will be no second wave. It's still a very uncertain situation that moves fast, but that's, I guess, a structuring assumption that I needed to call out. The Oxford University has put together an indicator that they call the stringency index, which basically tracks and compare the policy responses of various governments in order to manage and contain this pandemic. So the way to look at this is that on the scale from 0 to 100, obviously 0 means that there is no restriction at all, and 100 is actually corresponding to the strictest basically set of measures taken by government. So it's a composite measure which takes into account limiting movements, school closures, travel bans, etc. As you can see here in this selected group of countries, it varies. We know that some countries had to deploy some lockdown measures earlier than others. Typical example is obviously China, Italy, which was the first country hit in the Eurozone. And what I think is interesting to observe here is that whilst all these countries were quite fast in deploying those measures, actually we observed that even though there is a gradual, let's say, return to eased measures, we see that it takes time. And the bottom line for the real economy is that it will take time before we go back to normal. Another way to look at this impact on the real economy when you think about these lockdown measures is an interesting indicator, which is actually the Google mobility data. So admittedly, when you first discover this data, it's quite scary how much Google knows about us. But putting this aside, these indicators are quite trendy, and they've been, let's say, talked about very much over the last few weeks because they are available on a daily basis, whilst typical indicators to observe what's happening on the economy usually take time to be released. I'm referring to GDP growth, retail sales, industrial production, or PMI indices. Whilst here, as you can see, we've taken UAE, KSA, and Egypt, and it's interesting to observe that the orange line, which represents grocery and pharmacy mobility, has obviously been less affected than other sectors, such as transit stations. So basically, transit stations corresponds to subway stations, airports, seaports, taxi stand. It's a mobility crisis. So obviously, these have been highly impacted. And equally, although slightly to a lesser extent, we see that retail and recreation across these three countries have also been severely hit, which has obviously an impact on the real economy and on household consumption. So again here, when you look at the trends, we see that there is a slow recovery and back to normal. The zero level would represent here normal trend, but still it takes time. It's faster in some countries than others, but still some good news which I think are interesting for the period to come. So what does this mean for the world economy? So with no surprise, I think analysts and economists have been forecasting with different level of extent, but all in the same direction, a deep recession for 2020. I think it is interesting to note that this recession expected, this severe contraction that we forecast at Coface of minus 4.4% for the world economy this year will be bigger negative-wise than what it was during the great financial crisis of 2009. There is still some persistent uncertainty, but it's obvious that there will be an increase in household precautionary savings on the one hand, and also some postponements, if not cancellation, of some business investments and government spending, especially for the Middle East countries. It will be followed by a quite strong recovery. However, I think it's also important to note that for some of the largest economies, I'm thinking about the US most of the economies in the Eurozone. It's also the same for UK and Japan. The level of recovery next year will not be enough to bring back the economies to what they were at the end of 2019. So that's, again, an important factor and forecast that we are making as Coface. So again, this is on the basis of a no second wave scenario. Now, if we move to what it means for business insolvencies. So at Coface, because we insure against payment defaults, we have some models to forecast and analyze the evolution of business insolvencies and bankruptcies across the markets where we operate. So usually we make these projections on a calendar year basis. However, this time is a bit tricky to analyze, and there is a reason behind this, is because there's been a quite intense and many initiatives from governments in terms of fiscal or monetary stimulus, and this is valid very much as well across the Middle East. These range from lower interest rates, from minimum reserves for banks that have been reduced, basically giving them ammunitions to provide more lending. There are also some liquidity injections for some of the commercial banks with clear instructions to help some of the troubled SMEs. And there are also some extra fiscal measures such as tax deferrals. So when you factor all of this, we don't know how long all these government lifelines will last. And so that's why it's difficult to predict whether the insolvencies will finally come through either at the last quarter or more likely in the first half or even up to the end of next year. So that's why this year we are projecting an increase of 33% of business insolvencies worldwide compared to the level, the number of insolvencies that we witnessed in 2019. It varies again between countries. Emerging economies, and especially in the Middle East, are also quite impacted due obviously to the lockdown measures, but also due to the fact that there is a fall in tourism. There is also a decrease in expat workers' remittances. And last but not least, we'll discuss this later, there is a deep impact on commodity prices and oil in particular. So when we look now at the Middle East economies, it will be as well a recessionary year for the Middle East economies. These are the numbers of the IMF for 2019, and we also use IMF sources together with some of our own projection to forecast the growth of the economies. And as you can see here, Lebanon, we may have an opportunity to discuss this later on, is heavily impacted after already a very difficult 2019 year. And we will be between 2.3% negative growth up to 4.3 among the other economies that are highlighted here. Interestingly as well, and this is, I guess, not a very good news for the diversification strategies of the GCC countries, the non-oil sector will be more severely hit and impacted than the oil sector in 2020. Let me now take you through some insights on what's happening on the oil market and what it means for GCC economies in particular. So if you look at the left graph, how to read this graph? So for each country, we have three columns. The first one represents the share of oil in fiscal revenues, essentially what governments are receiving in terms of income. The middle column corresponds to the contribution of oil to the overall country GDP. You can see here, for example, that despite being a oil-rich country, UAE is a very well diversified economy compared to others. And on the last column here, what we see is the share of oil revenues compared to all export revenues. So it's quite clear that, again, despite all these strategies of diversification that many GCC countries have initiated over a number of years now, the dependency to oil is still very much a challenge. And when you look at the right chart, what we see there is the fiscal break-even price for these governments basically to have a balanced budget. That doesn't mean that governments are expecting or basically preparing their budget based on these fiscal break-even prices. But what's important to keep in mind is that though the oil price is above these levels, it means that governments are running deficits. They are running surplus, fiscal surplus. And when it's below, obviously, they are running deficits. And this has an impact on their fiscal policy and obviously on the measures potentially that they are taking tax-wise and in terms of also trying to generate other source of revenues and notably borrowing as well, which is an interesting trend happening now in GCC countries. So we are forecasting as Coface that the average oil price this year would be at $35 per barrel. Just as a basis of comparison, it was $64 on average last year. So very deep impact for the GCC economies. We don't believe that what's happening on the supply side, and notably the OPEC agreement, will be enough to basically compensate for the quite high drop in demand that we have observed in Q2. According to analysts, 30% up to 30% of oil consumption drop in the month of April, back to 25% drop in May. We're hearing now it could be up to yet 17 or 15% drop in the month of June, even though the IMF and OPEC countries are projecting on average for the whole year 8 to 9% decrease in consumption. It could go as low as 20%, especially if growth is not as good as expected for the third and fourth quarter. So when we combine all of these elements, we actually produce as Coface what we call a country risk assessment. Just to not to confuse you with maybe what you are familiar with, which are the sovereign debt rating that are issued by some of the credit rating agencies. Our rating is illustrating the level of quality of business environment and also the risk of businesses defaulting. So there are color codes and letters, and what you see on the bottom left here is that when we issued our latest quarterly barometer, which is available, it's public information available on our Coface Group website, you can see that a number of countries in the Middle East have been downgraded, mainly driven by the impacts that I've mentioned earlier. We also run some sectorial analysis in order to assess which sectors are actually presenting the highest risks of defaults. And obviously, the trend is also, unfortunately, not that good on most sectors, even though some of them are more resilient. So I'd like now to share with you what we are observing on our business year to date and share with you some insights on claims trends, actually. So our typical contracts offer 6 to 9 months coverage in terms of trade credit period for our customers. So realistically, it is still early to observe the direct impact of the pandemic and the lockdown. Nevertheless, because Middle East economies were already most of them in, if not recession, but decelerating growth trend, especially in Q3 and Q4 last year, we start to see the effects on our claims trend and on payment delays. So on the left side, what you see there is essentially the frequency. So the blue line is highlighting the average number of claims we were receiving on a monthly basis throughout 2019. And we see clearly that since the beginning of the year, we have an increase again compared to last year. On the right side, the red chart, here we see the same trend, unfortunately, when it comes to severity. And these data, for obvious confidentiality reasons, we're not sharing the numbers, but we thought it was interesting to at least illustrate the trend so that you can witness that we actually already see for the Middle East, which includes GCC, but also Levant countries, including Egypt also. We are seeing both for domestic trade, but also for export trade that comes from the rest of the world to our region, a crystal clear increase in terms of frequency and severity. Another interesting piece of information that I can share with you is that the recovery rate that we usually observe is in the range at this period of the year of 40%. Recovery rate means for claims that have been open during the current underwriting year, we would have already recovered by our debt collection agencies 40% of that claim amount. This year, we are only at 10%. So obviously, some businesses are inactive. Our debt collection network has not been able to visit debtors and to collect payments. So there is a contactability issue certainly there, but certainly there is also the evidence that there is a drying up of liquidity in the supply chains, and we believe that these are the very first effects, at least in terms of payment behaviors of this pandemic. Now, I'd like to conclude by sharing with you some insights about how we've been reacting to this situation as Coface here in the Middle East. So in such an adverse economic environment where we expect, as I was mentioning earlier, an increase of bankruptcy worldwide, we had obviously to take some preventive measures, and we have to accept that new business and our risk appetite will be severely impacted. So that's why we are very much focusing on trying to protect our top line, and we are very much obsessed by client retention as we speak. We have, just as an example, reallocated some of our new business sales teams to give some support and provide some extra capacity to manage the intensified communication that we are basically conducting with our customers and with the distribution partners that we are dealing through. We also have conducted a number of webinars in order to articulate what was happening on the macroeconomic level with what is happening at sectorial and country level in order to help basically our clients and brokers understand the reason why we were taking these quite intense decisions in terms of reducing credit limits that were in place. We also have to protect our portfolio and our bottom line. So I will not dwell too much on this, but we have to acknowledge that in this current environment, There are some risks that are simply no longer insurable. It depends on the countries, sectors, and pieces of the value chain where businesses are operating. But definitely, we had to take some reduction measures on our exposures. Just to give you an idea, what we call preventive actions is basically reductions or cancellations of credit limit decisions. And these have simply doubled in the first quarter of this year in comparison to the same period last year. Last but not least, we are also trying in this difficult environment to reprice our product, because the risk environment we're operating in is certainly not the same. Our industry has been absorbing some continuous trend of price decrease over the last few years, and now it's time to use the opportunity of renewals to reprice our covers, because again, we are not living in the same environment. So that's it from my part. I hope it was insightful and helpful, and I'll be pleased to answer any question you may have later on.
Thank you, Hassan. Thank you so much. It was really interesting. We'll be saving the questions for the last. Now we will move to a journey on the products of the insurance and the effect of the COVID with Adelan Meselem, our second speaker. Adelan is the CEO, Asia, Middle East, Turkey, and Africa at AXA Partners. Within AXA for almost 20 years and in CEO position for 10 years. Adelan started his career as a life actuary with technical and financial management positions in AXA France for more than 8 years. After this significant experience is a well-structured environment, he jumped into a breathtaking entrepreneurial endeavor of building AXA insurance entity in Algeria from scratch. After 7 years, Adelan enlarged his scope and became CEO for the Middle East, Turkey, and Africa at AXA Partners in 2017. This successful mission allowed him to expand his perimeter by overseeing Asia on top of the Meta since June 2020. Congratulations, Adelan. The objective is this vast and heterogeneous region is to be more and more present in customers' everyday lives by developing innovative products through B2B, B2C partnerships. In parallel, Adelan Meselem have other mandates and role within the AXA group, such as, among others, board member of AXA Partners Algeria and chairman of AXA Partners Morocco. Lecturer in several high schools and universities on different fields, he teaches the financial steering of an insurance company, the actuarial technique in life and non-life insurance, and the retirement models. In 2014 and 2015, Adelan has been nominated by Choiceul Institute 100 Africa as one of the 100 young leaders who played a major role in the continent's economic development. In 2014 as well, Adelan received the Chairman Award from Henri de Castries, the former chairman of AXA. Adelan, the floor is yours.
Okay. Shukran, Sharbal. Could you confirm that you hear me well?
I hear you well.
Okay. So, few words in Arabic. أهلا وسهلا والسلام عليكم كلكم. إن شاء الله كلكم على خير أنتم وكل أهلكم. وقبل ما ابتدي أود أن أشكر
Adelan, just for info, there's also we have non-Arabic.
Yeah. I will switch, yes. أشكر شربل وشديد ري على هذه المبادرة، وأقول كل الشرف والسعادة أن أحدثكم اليوم على هذا الموضوع المهم. So thank you very much, Sharbal, for your introduction. It is a great opportunity to gather some professional from insurance sector to have this very interesting discussion on the COVID-19 impacts across the world and in our region. I would like to warmly thank Hassan for the excellent presentation. It was quite insightful, and it's a sort of introduction to the presentation I will do now. So I'm going to present an overview of the COVID-19 impact on the insurance sector. It's very important to mention at the beginning that I will not be exhaustive and deep dive in all the details. My objective is to comment on the most important consequences of the COVID-19 according to my point of view as insurer. Some information I will share with you today are well known by all of you, and I will try to mention as much as possible the references I took for that. And once again, I will try just to simply give you a general overview of the impact in our sector. So in this first slide, you can see the agenda I will follow for the presentation. We'll start with an introduction, then we'll comment the overall impact of the insurance sector seen by some experts and rating agencies. Then we'll fly over some lines of business, such as personal lines, commercial lines, etc. We'll then go through some other impacts raised in the insurance industry. And to conclude, I will comment on key topics and key action we should implement as insurers. With no more than 8 million people infected, the novel coronavirus, commonly referred to COVID-19, has spread as fast as a flash and completely reshaped our world and our lives. This new strain of coronavirus with pneumonia symptoms has been first detected in Wuhan, as you may know, in December 2019. And 1 month later, the outbreak was declared a public health emergency of international concern, and the world started to refer to it as an unprecedented crisis. Even if a crisis as COVID-19 affects all business sectors, there are some unique considerations that impact particularly the insurance industry. The real shift for the insurance sector happened on March 11th, when the COVID-19 has been declared pandemic by the World Health Organization. Everything changed with this pandemic definition. According to the Center of Disease Control and Prevention, a pandemic is the sudden outbreak of infectious disease spread over several countries or continents, affecting many people. Denis Kessler, who is the CEO of SCORE, said pandemic shocks are known, they are rare, and they are severe, low frequency, high intensity risks, and are by nature the most destabilizing. In the mapping of all risks, pandemics are the most threatening. In the right side of this slide, you can see that COVID-19 is not the first pandemic of our history. We faced plenty pandemics across the centuries: tuberculosis, cholera, AIDS, influenza, polio, measles, smallpox, and so on. After this general introduction, I will move directly to the insurance sector. To comment on the impact on insurance, we'll start with the analysis done by the most important rating agencies and some experts. So, as you can see in the slide, according to the Boston Consulting Group, insurance sector is among the vulnerable ones, and the impact should be material and even hard. To do that, they evaluated the TSR KPI, which is the total shareholder return. But unlike the evaluation of the Boston Consulting Group, S&P, Fitch, and Moody's consider that the non-life insurance companies will be enough resilient toward this crisis and will most probably resist more than life companies that should be more affected. And let's say it differently, they consider that the insurance sector will resist and will be resilient, I would say, even if they make a clear difference between life and non-life. S&P considers that life insurance companies are more at risk of negative rating actions as a result of the pandemic than non-life players, because they have larger exposure to financial market risk, low interest rates with lower investment margins. If it comes now to talk about the GCC market, Moody's considers the risk for insurers in the GCC as a high risk, especially over the next 12 to 18 months. And why so? It's for a couple of reasons. I will try to comment now. Number one, with the presence of many small players in the market, the decrease of the business will increase the competition and the unhealthy competition. Number two, many insurers are relying a lot on their investment income. With the decrease of the interest rates, the slump of the equity markets, and the potential impact on the real estate, plus, of course, more claims, it would heavily impact the investment income. Thirdly, for the same previous reasons, equity market, real estate, the solvency ratios would be under pressures, leading to a deterioration. Last, the delay on premium collection and reinsurance receivables will impact the profitability and the capital of many actors. Let's now deep dive on some lines of business. As I told you in my introduction, the objective is not to cover all the lobs, but give some relevant impacts we have observed. On personal lines, the business has heavily dropped. However, the profitability is different from one line to another. If it comes to comment on motor, as displayed on the right side of the slide, there is a clear contraction of the new business and the top line more generally. However, there is a real improvement of the loss ratio and the combined ratio. This is clearly due to the lockdown, as the confinement led to an important decrease of the accident frequency. You can see then that after the lockdown, it is another story. If you see the graphs below, which are an internal extraction of some of our activities in the Middle East, Turkey and Africa region, you can easily notice that immediately after the lockdown, frequency and loss ratio are back to normal level. Our expectation just after the lockdown is as follows. On top lines, we see two effects. One negative, due to the economic crisis leading to a decrease in new car sales, and one positive coming from the fact that people would buy more cars to avoid public transportation. However, we foresee or we expect a dynamic in the second-hand vehicles market and not in the new cars. From a bottom line perspective or from a profitability point of view, we foresee a back to normal in claims frequency, and even more, we are expecting an increase of claims since people will most probably use more their personal cars or vehicles to avoid public transportation. Yes, what else? Yes, it's important to also to bring to your attention that the severity of the revenue decrease is partially, we can say mainly, linked to the digital capabilities of the market and the rules of the renewals. When the market is less digitalized or the renewals are not automatic, the decrease is much more significant. One last point on motor business. Since insurers are generating additional margin coming from the frequency decrease, they are under high pressures from the government, regulators, and consumers associations, asking them either to contribute to specific solidarity funds or to grant some clients with rebates or payment delays. Now in the slide 13, this new slide, you can see the estimated annual decline in motor claims in a couple of countries. The decrease in France, Switzerland, UAE, Japan, Turkey is around 10%, In some other countries, it is higher by far. You can see the case of India, South Africa, Spain, etc. Let's move now to travel business. It is certainly the most impacted line of business. How to say? Honestly, it's a total disaster and a real slump. On the right side of the slide, you can see that all the KPIs are red. Less top line, higher loss ratio, and higher.
Adlan, could you unmute? Unmute. I just muted everybody. Could you unmute?
Yeah, can you hear me, Shaba? Okay. So I was saying that all the KPIs are red. Less revenue or less top line, higher loss ratio, and higher core. And how to say, as a result, a severe impact on the EBIT. We have displayed on the bottom side of the slide some graphs showing how fast and how severe was the decrease in the travel sector since the beginning of the crisis. Turkey, UAE, Egypt, Kuwait, Bahrain, all the curves are pretty similar, okay? Some of you can question the increase of the loss ratio despite the presence of pandemic or what we call the non-event clause in the majority of the travel contracts. Three main reasons led to the increase of the loss ratio. Number one is that some terms and conditions don't exclude the pandemic risk, and some of them are not enough accurate, even if it is mentioned. The second reason is the pressure of some governments and regulators to keep covering clients even if the contract is crystal clear. And the third one is that some insurers trying to retain their clients and concerned by their reputation have decided to manage claims case by case and to do some important derogations. After the lockdown, we foresee different scenarios impacting the top line. The negative one is coming from the fact that the travel sector will not be back to normal before the end of 2021, according to some airlines and travel specialists. And the positive one is dealing with the penetration rate. We really believe that people will buy more travel insurance in the future since they have increased their awareness during the crisis, or this crisis, I mean. Another positive effect, it's a bit technical but very easy to understand. The crisis will push insurers to propose a new value proposition covering partially or totally pandemics and other risks. And as you know, it comes at a cost or it comes at a price. It means that it will boost the top line. One last thing on travel, it's obvious, but it's straightforward to understand that this line of business has been impacted similarly in all regions of the world. Few words on home insurance, even if I will not deep dive on it. The French market is observing a material drop on claims during the lockdown for two main reasons. The number one is the drop of housebreaking, minus 75%, because it usually happens during the day. And for the same reasons, water damages and fire have decreased since people could react more quickly since they were at home. This is the I would say the analysis done in the French market. However, some other sources across the world estimate that there has been an increase in claims since people are more present at their place and subsequently are using more their home and their home insurance. Yeah, let's move now to health business. I will comment only group health and not individual. During the lockdown, we haven't observed a real decrease on the top line. Why so?
Adlan, I'm not hearing you.
Adlan, we lost you.
Yeah. So seems interesting that the motor claims are having profitability. Something is profitable during the pandemic, which is really good. We just need to wait for Adlan to rejoin, but seems really interesting.
Shabil, I can add, waiting for him to come back, I can say that yes, the motor claims are diminishing, the assistance claims as well, but we expect higher claims between July and December of this year due to the fact that many people will take their car to go on vacation instead of traveling. So if you take the example of France, people are not traveling in France anymore, and they will drive around France with a higher frequency risk.
Okay.
But yes, this is the only line of business that got affected positively during the COVID crisis.
Yes, unfortunately, we in Lebanon, we cannot travel by car. It's either we go left or right. Patrick, what do you think about the health plan now before Adlan comes back? What are your perspectives? By the way, just to introduce you, Patrick is the Deputy CEO of Adlan for the Middle East.
Hello, everyone. On the health side, the very positive effect, but I think Adlan will speak about it, is teleconsultation. Adlan, are you back?
Yes, I am back. Can you hear me?
Yes,
now
perfect.
Yes.
Thanks,
Go
Adlan.
ahead,
Please proceed. You were on the health insurance side.
Yeah, sorry. Okay, so I was saying that we haven't observed a decrease on top line. Why? Because the contracts are annual, and in general, the companies maintain the medical cover for their employees. On the bottom line, overall, we are observing an improvement, and even a big one, in terms of profitability. I mean, surely some governments ask directly or indirectly insurers to cover COVID-19 related claims, even if it is excluded in the contract. However, the lockdown led to a heavy drop in medical usage and spending. People avoided to go to hospital and clinics during this period. As you may know, since you are the actor of this region, in UAE, in Saudi, in Algeria, for instance, governments and regulators asked insurance companies to keep protecting their clients, even if the contracts say different things. Like motor line of business, the governments and consumers associations are putting pressure on insurers to contribute to solidarity funds, injecting the excess of their margins in this line of business. After the lockdown, we see good opportunities and very good opportunities in this line of business for many reasons. The lockdown was the occasion to enhance telemedicine, teleconsultation, and we really believe that this trend would continue in the future. The second reason is that insurers will most probably add COVID-19 cover in their current policies. And as for travel, it comes at a price, and again, it will boost the top line. Now, on commercial lines, as it's written here, all the major lines have potential to be negatively impacted by COVID-19, as property, financial lines, and business interruption. Will not comment all the perils or all the guarantees. I will say only a few words on BI, business interruption, and liability insurance. For business interruption, as you may have seen, it popped up several times on headlines. And how to say, as a matter of fact, the lockdown has been a disaster for economy and economy, especially for SMEs. Some of them are trying to get reimbursed their loss of revenue through the business interruption cover. But as you know, it doesn't work. A business interruption, all causes, doesn't exist. Otherwise, companies can claim anytime and for many reasons. In some markets, we can find a business interruption cover with a non-damage extension, which is a better cover than the classical one. However, it's quite limited. In the GCC and in the Middle East and even in North Africa, the BI, the business interruption, sorry, with the non-damage extension is very rare. However, specialists and experts are recommending to insurers to review carefully their TNCs, since the lack of accuracy had so far more impact than the nature of the cover itself. According to a sampling, an échantillonnage done by the French insurance regulator, ACPR, only 7% of the business interruption contracts sold in France are concerned by some issues. 3% out of the 7%, there is a clear non-damage extension and the insurer should pay. For the 4% remaining, there is an issue with the wording. So the lack of accuracy leads to the court, and as said by the French regulator, the judge would arbitrate. Maybe one additional idea regarding the business interruption. Actually, it's an initiative of the French Federation of Insurers. They are currently working on a new solution to cover SMEs in the future in case of pandemic. They are working on this CATEX insurance. It means exceptional catastrophe insurance. It looks like NatCat. All of you know the NatCat. But it is dedicated to cover economic consequences related to an exceptional event such as pandemics. Like NatCat, they will fund it through an extra premium added to the current business interruption premium in the contracts. On liability insurance now, very quickly, especially on the medical one, we should observe an increase of claims and lawsuits for many reasons, or for two reasons. Some people infected by the COVID-19, for example, and their families could claim in the future against medical malpractice. We may see as well an increase of medical professionals, doctors and nurses complaining against a lack of protection in the workplace. As you may know, many of those professionals have been infected by the COVID-19, and some fatalities occurred among this population. Okay, we'll move now to life insurance. Clearly, we distinguish protection from savings. On protection, the turnover should increase, since this kind of crisis raises the demand for protection, death, all causes, disability, etc., etc. However, this willingness to be more covered might be offset by the lack of liquidity and the decrease on purchase power. Now, in terms of frequency or in terms of loss ratio, there is certainly an increase of fatalities. However, it might be offset by the age limitation of the contracts. The majority of dead people during the crisis are over the age limit accepted in the majority of the contracts. If we now focus on the credit life business in the Middle East and GCC, out of our AXA experience, out of my experience in this region over the last months, we have observed a drop in new business due to lockdown and economic fall. However, the impact on the loss ratio is quite limited since the fatality toll, especially in GCC, is low and hopefully low. Some insurers might have been impacted by unemployment since they are selling ILOE and voluntary loss of employment in the region. Yeah, I will add one important idea. Many financial authorities in the Middle East, the Central Bank of Kuwait, Central Bank of Bahrain, Egypt Central Bank, SAMA in Saudi, asked banks to postpone or be more flexible with the installments for customers for the next 6 months, starting April 2020. Those decisions would affect the loan maturity and may impact the economy of the credit life contracts associated. On savings, to make the long story short, it's easy to understand that this line of business is dropping and shrinking due to, first, interest rates getting lower and lower due to some decision taken by the central banks to support the economy. Same story for saving contracts invested in stock markets or backed by the equity markets. You can see in the graph on the right side of the slide that the stock market have plummeted since the beginning of the crisis. Now I will add some or comment on some other impacts very quickly. So the COVID-19 crisis, and especially during the lockdown, has generated premium collection difficulties. And as I told you when I commented Moody's analysis, there is an impact on the P&L, on the balance sheet, and on the investment income. Secondly, as mentioned several times, insurers were and still are under the big pressure of governments, regulators, and customers associations. The regulators have even asked insurance companies to cancel or at least to cut their dividends in some cases. Third point, some claims increase in some line of business, such as travel, for instance, and the fact that the situation was very special at the beginning led to lower quality, impacting the customer satisfaction and the customer journey. And this situation impacted the reputation and the brand of some actors. And last but not least, the slump of the equity markets and the markets more generally has put the balance sheet of insurers under stress, and there is a clear impact on the solvency ratio. In this slide, I tried to model or to represent the impact of the crisis through the revenue and the profitability, illustrating the severity of the impact according to some specificities. Very easy to say that if the insurer is monoliner and developing only travel business, it's going to be a disaster for this company from a revenue and profitability point of view. If it is a monoliner on motor, the crisis is impacting negatively the revenue, but positively the profitability. And if you are a multiliner with a balanced portfolio, the impact would depend on the weight of travel, motor, health, etc. And I will add some specificities you can see in this graph, which can make the difference. The quality of your underwriting, the accuracy of your TNCs, your level of digitalization, your footprint, are you local, regional, or international, the level of your reserves before the beginning of the crisis, and how the regulator is intervening during the crisis. Now, as a conclusion, I would like to mention with humility 5 axes all insurers should work on it to better understand the crisis, to mitigate and contain as much as possible the effects, And last but not least, to prepare the future. Number one, the insurers should perform crash tests on the impact of each line of business within the next 6 months with several scenarios to understand the potential impact on their P&L, balance sheet, and solvency ratio. We should, as insurers, screen all our TNCs, especially for business interruption, travel, and liability, for a perfect accuracy in the wording for the future. To think about the digitalization of the whole value chain to prepare the future. All the value chain, it means sales, claims management, renewals, and so on. And to work on new value proposition and guarantees to fit the customer's new expectation and the new ecosystem. By the way, I think that we would have huge opportunities in health, telemedicine, teleconsultation, and in travel new generation. But we can also tackle new opportunities in many lines of business. That's it from my side. Thank you very much. I hope that it was clear and insightful.
Thank you, Adlan. Thank you so much. It was really interesting. I would ask our attendees if somebody has a questions just to raise his hand, and I would follow the questions. Isam Muslimani, you have a question?
Yes, thank you, Charbel, for the opportunity. Maybe a quick question to both of you. Maybe I don't know who can pick it up, Adlan or Hassan. About the opportunity you believe it exists now, and what could be the role of the reinsurance, because when we talk about such a high frequency or maybe severity of claims, there should be a huge capacity to manage, and what could be the underwriting measures. And if you allow me quickly also, you mentioned about motor is making profits. I would quickly explain and describe the insurance situation as a bowl, which includes stones at the bottom, and there is water, of course, which is the premiums. When the premiums drops, the water will drop, but the stones will remain in the bowl, and for me, the combined ratio ultimately will be exposed. I don't think with the pressure on the top line, any line of business will be profitable ultimately. Thank you.
Thanks, Isam. Adlan, would you take the answer on this one?
Yeah, thank you very much, Isam, for your comment. On motor, I totally agree. My point was to say during the presentation that compared to travel, the impact was less important, because if you see a decrease in your revenue and an increase in your claims, it is a catastrophe for you. For motor, you are right. We should be mindful and make sure that the decrease in frequency will not lead to a decrease in the pricing in the future, because some clients or some customer associations are asking for a decrease in the pricing, taking as assumptions the low frequency during the lockdown. And I showed in this presentation that just 1 week after the end of the full lockdown, the frequency was back to normal. Okay, and totally agree to say that if in the coming months after this lockdown, the economic situation is difficult, so the top line will suffer a lot, and without revenue, ultimately the combined ratio would be severely impacted. So I totally agree with your analysis. But once more, motor, it was less difficult than travel and some other lines of business. On opportunities, I don't know if I got very well your question, but we see many opportunities in travel, in health, etc. And even in commercial lines, we really think that insurers can play an additional role, covering some impacts of or some risks related to COVID-19 or similar pandemics in the future. But you are right. If I'm not wrong, you talked about the underwriting rule. So we should redefine the underwriting framework, and we should review the risk mapping, because people and companies, SMEs, in the future will ask for a higher cover, a better cover. So it is an opportunity in the sense that we will boost our top line because we will have new demands, but we should price properly those new risks. And the challenge I see as insurer is how to price properly those new risks with a very short and poor experience. Thank you.
Thank you, Adlan. Anyone has a question? Muhammad Taishat.
Hi, how are you, Sharbel? How are you?
Hi, Muhammad.
Yeah, in fact, I have a quick question to Mr. Adlan regarding travel insurance. Do you think the insurers will cover the pandemic under travel insurance policies in the near future?
Thank you very much for the question. Yes, they don't have the choice. Otherwise, people will no longer buy travel insurance because at least now, I mean, immediately after the crisis and after the lockdown, if insurers are not able to bring to the table a new cover, taking in consideration the COVID-19 and its impacts, they will see a material drop on travel business. And many governments, airlines, travel specialists are contacting currently the travel insurance companies or the insurance companies to ask them to provide them with a new offer, new value proposition covering the COVID-19. And I really think that if some insurers are not able to answer to their current partners providing this COVID-19 cover, they will lose their current partners. This is my conviction.
Thank you.
You should unmute Sharbel.
Sorry. So my question is for Hassan. It's a quick question. So I need to know what's the impact on the expatriate population and the region. What is the impact on the Middle East tourism? I want to know more about what's happening in Lebanon. Very briefly. In Egypt, will the KSA tomorrow, they will increase the VAT to 15% in KSA, will it affect the region? So I made like some, but if we can start by the impact on the expatriate population and the Middle East tourism.
Sure. There are a number of topics and rather burning topics. Let's start first with the expatriate population. So it's obviously directly linked to job losses. I mean, everybody is well aware that in GCC countries there's a significant part of the population which is made of expatriates. Unfortunately, I would not name the companies, but it's all there in the news. We all know that some of the notorious brands and groups, whether it is in retail, hotels, hospitality, airlines, even in oil in Saudi Arabia, have basically triggered and started to make a number of people redundant. There are some companies that are, let's say, a bit more amenable in the way they are basically terminating people, allowing them to stay on unpaid leave for some of them for a year, allowing them to get non-objection letters and to find other jobs. But the reality is that, especially in those sectors, the drop of demand and the shock is so high that there will be for sure impact on expatriate population. I think there's a paper that has circulated that was quoted in the media from the Oxford economics, which were forecasting 4% population drop, for example, for Oman and Saudi Arabia, up to 10% for UAE, I think over 12% for Qatar. So we're eager to see if it comes through. That's obviously very impactful. We believe that it's too early to really find out how big will be the extent of population drop for two main reasons. The first one is that obviously due to the travel bans, people have just been prevented from moving and getting back home for many of them. And then, especially for the more affluent expatriates, because schools have not yet closed or are about now to finish, it will be interesting to see admissions in September in schools. And it's not only important for the GCC economies where there is a big chunk of expatriate population, but it's even important for the rest of the Middle East countries. Remember that many countries in the Middle East rely on the expatriate worker remittances from their diaspora in those GCC countries. As an example, Egypt, but one of the quotes from one of the forex houses is that remittances year to date from Dubai to Egypt are down by 65%. So that's massive for Egypt, who we know is, how to say, structurally fragile when it comes to forex reserves. You talked about tourism as well. So obviously, countries in the Middle East are in different positions. They don't all depend as much as each other when it comes to contribution of the overall tourism sector to the GDP. The highest impacted countries, unfortunately, are Jordan and Lebanon, where almost 20% of the output for the country comes from tourism. So obviously, these countries will be severely impacted to a certain extent as well. Egypt, I think it's 12%, UAE as well, 11%, and some other countries will also be affected, even if tourism does not represent such a big part of their GDP. Still, in terms of jobs, we're talking about many jobs that are directly or indirectly benefiting from the tourism and the wider industry. When you think about airlines, when you think about hospitality, airports, there's I think there was a study that came very early, as early as March or April, a document from IATA, the International Association of Travel Agencies, who forecasted 300,000 job losses in the as a consequence of the tourism basically situation in the UAE, 200,000 in both Saudi Arabia and in Egypt, and even 100,000 they were forecasting for Lebanon. So that's obviously a big impact again, and it has unfortunately many adverse consequences. notably when it comes to the level of forex reserves of these countries. I'm thinking in particular about countries like Lebanon, but also Oman, Bahrain, Jordan, Egypt, which have a structurally fragile position when it comes to their currency. I think you mentioned the VAT introduction in Saudi Arabia. I think the best way to understand it, because there were many comments about this decision. One number which I always personally keep in mind is in 2015, the forex reserves of Saudi Arabia were above $700 billion, above $700 billion. Right now, it's estimated to be at 450. So that's a significant drop. Although it's still very comfortable, I think it represents more than 2 years of import. Nevertheless, Saudi, and I think it's a wise decision, before being forced to let's say severe austerity measures, is starting to put in place some mechanism where they can diversify their sources of revenues and also not be too much reliant on borrowing as they've always been doing. So unfortunately, when most countries are basically introducing fiscal stimulus, it seems like a bad decision at the bad time. But I think that there are numbers that have also circulated in the media, quoting that these VAT that has been tripled, effective tomorrow, actually, could generate up to $25 billion of yearly income for the government. When you think about the fact that the government is about to borrow 60 billion this year, it's quite impactful. We don't believe, and even when we discuss with the various authorities, that this would set a trend for GCC, other GCC countries, at least not for now, because they don't have the same financing needs, especially the UAE. Lebanon is unfortunately often referred as the worst market right now as we speak in the Middle East. From a Coface perspective, we've been downgrading the country risk assessment for a number of months now. I'm not disclosing anything confidential. We've been withdrawing our limits for a while now in the country. The GDP is expected to be down at least by 20% this year. We know that the talks with the IMF are still ongoing following the suggestion of this emergency package. I think the big decision, the most structural decision that we are yet to see now for Lebanon is, will the country go to a flexible exchange rate? I'm sure you are more knowledgeable than I am about this. I've heard that on the black market, the Lebanese pound went up to 4,000 to the US dollar. So there's definitely something to be done there, because the 1,500 pound to
no
the
comment
dollar
on the
peg.
exchange rate, but
Yeah,
it's
it's
reached 10,000.
simply
It reached
10,000.
10,000.
Wow. I've not even heard that. So yeah, it's just unbearable. Just one last comment on Lebanon. We see some payment delays and some payment claims, although we were very selective in making sure we were not exposed to what we would consider as the weakest buyers and sectors. Nevertheless, despite this, we've been hit by the fact that the government has introduced some capital controls, which means that even though the companies had the ability and the funds in their banking accounts to pay, they were not allowed to transfer funds by the government. So unfortunately, pretty gloomy outlook for Lebanon. Did I cover everything, or were there other points you mentioned?
Egypt in 1 minute. Egypt in 1 minute.
Yes. So look, it's also a big impact for Egypt. Tourism is down. We expect. I think the numbers I've read are referring to $12 billion of shortfall in tourism revenue this year. The same amount for Suez Canal revenues. I've mentioned already the lower remittances from Gulf countries and notably from Dubai. The forex reserves are under pressure. They were 45 billion at the end of last year. They're down to 36 now. The good news, though, for Egypt is that unlike other countries that I will not quote any longer, there were some emergency fundings that were agreed and that were provided by the IMF, the World Bank, the African Development Bank. So this is definitely helping the country to inject, notably in its banking system, some capabilities. There was a news yesterday, I think, that some credit guarantees would be extended by the government. Yeah, the last area of concern I would mention again is the Egyptian pound, which possibly is maybe still overvalued as we speak right now.
Okay, Hassan, just a quick thing. Jordan, Oman, Bahrain, in a glimpse, just to finalize, a minute, so everybody knows about his country and Qatar.
Yeah, so maybe Oman and Bahrain, unlike their neighboring GCC countries, they don't have the same capacity to borrow. And that's a big problem. The spreads for these two countries are far above the financing conditions that countries like UAE, Qatar, or Saudi can find in the international markets. The other issue for these two countries is that in normal circumstances, there's always the help and lifelines that are thrown by the neighboring GCC countries, but they have their own issues now to deal with. So there are speculations within banking circles that even the currency peg for these two countries could be at threat, Oman and Bahrain. So that's I think an area to watch. I'm not that familiar, admittedly, with the latest news coming out from Jordan. I can only comment on the fact that thanks to our partnership with the Jordan Loan and Guarantee Company there, we have exposure to some of the exporters from the country, notably in the fertilizers industry. And I can tell you that the level of activity and trading has been significantly impacted. So Jordan as well will be severely impacted. I've mentioned earlier the dependency to tourism, close to 20% of the GDP. And that's why in my earlier slides, we were projecting also a quite steep recession for Jordan this year.
Thank you very much for your time. I think just one questions by Fritzi. Fritzi, you meant if COVID coverage will be added to the health insurance. I think Adlan replied to that by saying if you're not going to offer COVID cover, you'll be out of the market in the future. Thank you so much, everybody. Thank you for attending.